Hello and welcome to the Global Dialogue. I'm Shireen Bhan, and today we're in conversation with the Global CEO of HSBC, Noel Quinn. Noel, thanks very much for joining us here on the channel. And it's good to have you back in India post the pandemic.
Thank you. Thank you. It's great to be here.
So that's where I want to start, Noel. You've been meeting with clients in Mumbai, Delhi, Bangalore. You've met with different people from different sectors, different verticals, different businesses. What's the sense that you pick up about the strength of the Indian economy and the strength of the India story?
An extremely positive sentiment, strong numbers, good optimism for the future. And I contrast it with the last time I was here pre-pandemic. And I think everyone had hope and they were optimistic. But there was a question mark, will it all become a reality? And what I've seen over the last few days talking to customers is it is becoming a reality. Very strong growth, the numbers are good, stable political situation domestically, good foundations in place with the digitisation of the economy, strong consumer demand domestically, and increasingly becoming a supply base to the world. So very optimistic.
I'll talk to you about the changes that we're seeing in the supply chain in just a minute. But since you talked about the confidence that you see in the India story and the Indian economy, what does that mean as far as your own plans for India are concerned? Pre-tax profit of a little over $1 billion. You've been growing at 10% per annum here in India.
Yeah.
Are we likely to see a significant expansion here? And what could that mean?
I'm really pleased with the growth we've seen. And the great thing is it's been consistent for the last 10 years. And that was one of our ambitions. Not start, stop into India, out of India, but consistent growth, consistent investment, and be a sort of a reputable player that people can rely on. We're dependable, and we're there for the long term for India. And that's my plan going forward. Continued investment is definitely coming across all business lines. Commercial banking, retail and wealth, and our global banking and markets business. But we'll be there for the long term. It's not just one spurt of investment and then walk away. It's consistent, long-term investment.
Possible M&A here in India as well, in some of those areas that you spoke of. And I know that you want to focus much more on the wealth management side, on the asset management side. Would those be areas of opportunity from an M&A perspective?
Well, I'm pleased to say we've already done our first deal with the announced acquisition of the asset management business from L&T. We're hoping to get approval on that very shortly, and that's a good platform for future growth in asset management. And I'm willing to consider further acquisitions should they become available in the future. You will also be aware that we're already in a joint venture on the insurance business. We've announced that we are in discussions to try and increase our share of the joint venture to 49%, and we'll see how those discussions go. But that's, I think, a measure of our appetite to continue to invest in India. Credit to the team. In the first 6 months of this year, they've grown the pre-tax profit of India by 22%.
You talked about the changes that we are seeing in supply chains, and you believe that this is not deglobalization, but it's reglobalization, and that's what I want to pick up on. How much of this reglobalization is going to benefit India? What we are starting to see is, people are looking at nearshoring, so moving manufacturing facilities closer to the home market. We're also seeing this China plus one strategy play itself out. Where does India find itself in the middle of all of this?
Well, I think there's a number of factors at play. I think geopolitics is one of the factors. I think COVID made an awful lot of buyers realize they shouldn't be over-dependent on any one source of supply or any one particular supplier, that they need to have contingency in their supply chain. And I think resilience is an important factor in supply chains. So that's why I use the word reglobalization. I think people are adjusting supply chains for a range of factors, and they're sourcing from multiple countries and multiple suppliers. And I think India has huge potential to be one of those suppliers going forward. We're seeing evidence of that already in that manufacturing plants are starting to be built in India. And credit to the government of India. They've created an environment that is stable politically on a domestic front, but they've also made substantive changes to the way the economy works. The introduction of GST, the digitization of payments, the digitization of identity, make it that much easier for a foreign company to come and establish a base here in India.
I'll talk about the digitization advantages in just a second, but let's talk about what's happening globally at this point in time. It's an increasingly uncertain environment. There are challenges on the inflation front, there are challenges on the energy front, and all of that is exacerbating the dilemma that central bankers are faced with. We've seen the ECB move with a 75 basis point hike last night along expected lines. The Fed is basically saying, look, we will do whatever it takes to rein in inflation. What do you make of what this is going to mean as far as growth is concerned? If there is going to be a recession, how deep do you believe that recession is going to be, at least in some of these key developed markets?
I think the important thing is to look at the economic impact on a regional basis, because it's different for different regions. I think continental Europe does have a challenge in that there's significant price inflation, but there's also an energy supply concern. The UK and the US have less of a concern on energy supply, more of a concern on energy inflation. And then if I look at the Middle East, very different economic circumstances, a very strong economy in the Middle East. And Southeast Asia, very strong at the moment as well. Nobody's going to be immune from an economic slowdown, but I think the impact of it will be different in different regions. And I think you see in Hong Kong, there's gradually a rebooting of the economy there as COVID lockdowns have released. So I think you've got to look at it regionally, not globally. And here in India, I think India is extremely well positioned to ride out an economic slowdown. It has strong domestic demand. It has good FDI, $83 billion worth of FDI last year, strongest ever. It's starting to build up good trade flows. So I think India is well positioned to ride out an economic slowdown.
Mm-hmm. And, the question then is what happens to fund flows, and will fund flows continue into markets like India? And, we're often sort of equated with other emerging markets as well. Do you believe that with interest rates tightening the way that they are at this point in time, that could potentially impact fund flows into markets like ours?
I think India is in a good position relatively for positive fund flows, and I think that's all credit to the way the economy is being managed. During COVID and post-COVID, rapid response in the build-up to COVID in India, rapid response post-COVID to adjust back to more normalised economics. On interest rates, by the way, it's good to see that normal monetary economics are starting to re-emerge. 0% interest rates is not a normal monetary policy. Now, we're all concerned about them having to rise too fast, too high in response to inflation. I'm hoping that, and have a belief that some modification will take place in the demand curve because of inflation, and that maybe rates won't have to go quite as high as we currently think, because demand will adjust, not because of rates, but because of inflation. And I think there is some evidence of that starting to emerge. In terms of India, I think it's really well positioned as an investment market and future FDI coming into India.
Mm-hmm. You said that we might see demand taper on account of inflation, and hence the expectation that we are going to see significantly higher interest rates may not pan out. What would be the rate that you are at this point in time looking at? What do you believe we are going to see the Fed move to?
Well, listen, it's very hard for me to predict what the Fed will do, but I think everyone's baked in a pretty certain future of at least 4%. It could go higher, and many people believe it will. I think we're going to have to see how the demand curve changes over the next few months. But certainly we can be looking at 4% interest rates from the Fed, and potentially higher than that.
Let's address inflation. Let's talk about what that means for a market like the UK, for instance. The new British Prime Minister has started off by capping energy prices or energy bills for 2 years now. And that is likely to have a significant impact on reining in inflation, as well as providing some degree of liquidity to the end consumer. How do you see this playing itself out? And would energy shocks be one of the top risks facing the global economy today?
Yes, I do believe that to be the case, and I think it's a very positive move that the new Prime Minister made yesterday. The price inflation in the energy sector in the UK wasn't percentages. It was 4 or 5 times higher, potentially in the next few months, than it would have been a year ago. And for consumers and small businesses, that price inflation of 4 or 5 times higher is not sustainable. It would have had significant negative impact on the economy. And it was important to address that, because that, I think, was the biggest risk facing the UK economy going forward. Yes, it has a positive impact on inflation. That hopefully should reassure markets. And the extra fiscal deficit as a consequence of that action is manageable, but it was a very positive move yesterday.
Since you talked about this divergence that we're seeing and how it's going to play itself out across different markets, at this point in time, Asia, India in particular, look relatively stronger or better poised in comparison to some of the developed markets. Would this be, as many are calling it, the Asian decade or the Asian century? What are your thoughts on that?
I think it's particularly strong for India. I mean, the visit I've been on this week, I think what I'm seeing is India is economically well managed, politically stable, domestically, infrastructure being built out to create platforms for growth, and the business community very innovative and very action-orientated. India is relatively really well positioned. I think Asia generally is. We've got to remember, Asia is a huge consumption market. So yes, it's going to be impacted by the world, but it has its own engine for growth in very large domestic consumer markets. And I think that will give it some resilience that maybe some other markets don't have.
Yes, I think the perception that Asia was essentially the factory for the world, but now also increasingly the consumption hub of the world, I think that's playing itself out. But let's talk about China. And what we have seen is, with the lockdowns in play, that has impacted growth. We don't know how long the zero-COVID policy is going to last. There's been other changes as well, the crackdown on tech companies, for instance, and of course the debt concerns continue. What's the view and the take on China at this point in time?
Medium term, long term, still strong economic growth. Again, a huge consumption market, a policy framework that is trying to drive that consumption growth into the GDP growth. Still a supplier to the world, but with more of the economic growth coming from the domestic market. And I think they will manage through the current COVID situation and find a path out of that. And therefore, we're still very positive on the long-term economic prospects of China. I think there were some industry segments that needed some correction. The correction has been faster than I think all of us expected and more decisive. Again, I believe once that correction has been done, it will return to a platform of growth. So again, we're investing in China the way we're investing in India, the way we're investing across Asia. From HSBC perspective, I see 4 strong pillars of growth: India, Singapore, Hong Kong, China. And HSBC is investing in all 4 markets to really get the 4 pillars of Asia, and Singapore particularly as a route to Southeast Asia. And that's where we're investing in all 4 markets at this point in time. We recently completed an acquisition of an insurance business in Singapore to build out our wealth and insurance capability, merge that business with our own, and build a much more solid platform for growth in Singapore.
You know, you talked about these 4 pillars, but I just want to labor a little bit more on China. And given the geopolitical concerns as well as the geopolitical flashpoints at this point in time, at least as far as FDI is concerned, do you believe that that is going to get impacted when we talk about China?
Listen, we've faced geopolitical challenges and geopolitical situations for the 157 years of our history. Geopolitics is a factor of being an international business and is a factor of being an international bank. We navigate that. Will it impact FDI flows, the geopolitical situation? Potentially, yes, it will. But we go through cycles, and as an international bank, we've been managing complex geopolitical situations for 157 years, and we will continue to do so. You can't be an international organisation and think there aren't geopolitics in play.
Now, I would imagine that that's been the nature of the business. But, you know, how different is the geopolitical environment today than it was, say, 5 years ago? Because, you know, you're seeing different kinds of flashpoints at the same time. There's Russia, Ukraine, there is China, there is what's happening with the US, there is Taiwan and China. So there's different flashpoints playing out together at the very same time. Does that make it increasingly more complex and challenging?
Clearly it's more complex, but there have been similar flashpoints in the past in other parts of the world, and you navigate your way through them. I always come back as a bank to my customers. And if I think about my own dynamics, what am I seeing, and why do I use the word reglobalization? If you look at our international account opening activity for businesses in the last 6 months, That activity is up 13%.
So there is no deglobalization in the way that we imagine it to be?
That activity was up 15% last year. The year before it was up 13% through COVID. International activity, despite COVID, despite geopolitics, despite shifting economic platforms and relativities, it's still happening. Our trade business was up 15% in the first 6 months of this year. Our trade business into India, I think, is up around about 8%. Sorry, we have an 8% market share of export activity in India. So my customers are still internationally orientated. The nature of their international business is changing. They're diversifying their supply chains. They're building in more resilience. They're sourcing from different parts of the world, not completely re-globalizing, but in part re-globalizing. That is a factor, and as an international bank, we're very much focused on helping our customers navigate a complex international world.
We'll take a break here on the Global Dialogue and return in conversation with the Global CEO of HSBC.